happen. But first, Michelle Snyder's here. She's going to break down how you should be playing this market. She's one of the most well-rounded people that comes on this show. So I say grab a pen and pad next. All right, let's face it. Thus far, 2023 has been completely off script, right? Some might even say it's eclectic, which is why I wanted to bring in one of my favorite investors. Joining me now, Market Gauge Managing Director Michelle Snyder. Michelle, I'm not saying that you're eclectic per se, but you do have an amazing breadth of stuff that you cover. And I want to start with the notion that you're saying that there's more stagflation to come.
Yes. Well, clearly we're already seeing it in the numbers, right? From the stagnation of the economy, even though we've seen sectors that are contracting, we've seen others that are expanding, which kind of equals it out. And then in terms of the inflation, even though there's a lot of calls for deflation, we're seeing areas and pockets like silver and gold and sugar futures that have just gone ballistic, which is sort of kind of what we saw in the 70s. And that spells really where we're at right now, including what the Fed has to deal with, which is what do we do? So stagflation means trading ranges, and that's kind of what we've been seeing since the beginning of the year.
It sounds then the outperformance comes from things like commodities then.
Well, that's one of the areas. What's so interesting is that I've discovered a time frame that I've looked at in the past, but it has been absolutely incredible this year. And that is based on a 2-year business cycle, and you can use a 23-month moving average. And if you put that up, Charles, and look at any instrument, you'll see things like the SPYs have gone right to the top of it, the Qs, the diamonds, and have stopped as the resistance point. And others have fall into a 6 to 8 year cycle, which we like to use an 80-month for, and have stopped and started to move up, like transportation and retail and the small caps. So there's your trading range. So it's really kind of simple, is that we want to look for things that have expanded outside that 2-year business cycle. Now we're seeing growth stocks do that, right? Where, Microsoft and Meta, Apple has already been there. Commodities have certainly been there. And there's a couple of other areas that we can discuss that are interesting and not classically looked at that are also expanding.
Well, I remember about a month or so ago, you mentioned sugar, and every time I looked at a headline, sugar is exploding to new highs. Let's talk about what happens today after the close. A couple of names that I know you watch closely are reporting. I want to start with Amazon. Are you long it? Should people be in this stock before they post those results?
Well, in terms of our growth stocks, we are quant model based, which is using basically trend strength. We're only in Meta and also NVIDIA, which also has to report soon. And looking at Amazon, because it's kind of a growth, but yet it also has a consumer aspect, I know this, the valuations are better, that the expectations are for 19.1% growth year over year, and it's all going to be a matter of whether it beats or not. From a chart perspective, it's well under that 23-month, right? But it's clearing back over the 80-month, and it could, with a good report, clear that, in which case that'll put it in an expansion zone, and I would say that's a good buy.
Talk about being off to the races. If there's some sort of positive surprise tomorrow with this PCE number, I mean, you talked about some of these key resistance points. I just know on the S&P, to me, if we can close above 4,200, I feel like we'd be off to the races. Any chance the narrative for the markets could be changed tomorrow?
I doubt it, based on the numbers that we saw today showing an increase in inflation. And of course, we know it's also a global problem. And just looking, let's go back to sugar. I know people think enough already with the sugar, but it's exactly what happened in 1976. It broke out 20 cents. It went up to 66 cents. Then it came down with that brief moment that we had where everything collapsed after the oil embargo. And then basically, the Fed made a little mistake. They went a little bit more quantitative, and sugar flew, and then everything else flew. So I'm telling, to me right now, I would be erring on the side of more inflation, not less.
I got you. Michelle, thank you so much, and we'll talk again very soon.